You worked really hard to build your business. Now don't just give it away to the government when it comes time for a sale. Now one big driver of how your business sale is taxed is going to be whether it's done as a stock sale or an asset sale. Now generally, the most simplistic terms, a stock sale is when someone actually buys the legal entity that you currently own that owns and operates your business. And an asset sale is when someone goes and buys the assets of your business, including customer list, the brand, any intellectual property, websites, everything's included in there, but then they're going to buy it with their own legal entity. But the two transactions can be taxed in a very different way, so it's really important to understand the difference. Now the big difference is kind of the easy one. Stock sales are typically taxed at the capital gains tax rate, which caps at 20% on the federal level. Your state might have their own capital gains rate. There's also a Medicare surcharge that can get put on top of that. But for this discussion, we're going to use the 20% federal rate. Now, asset sales are a little more complicated. Now, the value of the physical assets are typically taxed at ordinary income, while the value of the goodwill is typically taxed at the capital gains rate. Now, goodwill is basically the difference between the value of the physical assets that the business owns and the sale price. So if you have a business that sells for $1 million and has $200,000 of physical equipment, that means that the sale includes $800,000 of goodwill. So generally, as a seller, you'd prefer a stock sale so that you get all of the deal treated at the capital gains rate. But buyers want an asset sale because when they do an asset sale, they get to depreciate the value of those physical assets against their tax returns. And that can be a very big cash injection for that buyer in that first year when they need it the most, because it might mean that that first year's profits could be tax-free because you're depreciating all of those assets. And that really depends on where we stand on the tax code. What the buyer can depreciate in for the first year is kind of a moving target right now, but that's a different video. But just realize that typically in these transactions, their gain is your loss, your gain is their loss. And by default, most business sales are done as asset sales. So generally that's the position that most buyers are coming in, and that's what they're expecting. Now there is something you can do to get the best of both worlds. It's called an f-reorganization. Now these are really common in big private equity deals, but virtually no one's doing them in the small business space, and they're a really great tool to reduce taxes. Basically, it's a way you can structure the sale so that the buyer gets the benefit of an asset sale, while you, the seller, get the benefit of a stock sale. Now, it's a pretty complex transaction, moving things around between entities, but we have a tax attorney that we work with that does these every day. So he has it down to a very good process. And the tax savings from these can be huge. So we did one for a trucking company. It had $1.5 million of physical assets, the trucks. Now those assets, typically they're gonna be fully depreciated, which means that you're gonna pay ordinary income taxes on that portion of the sale. That can go up to 37%. But if you do an f-reorg, you can reduce that to the capital gains rate of 20. So that means in that transaction, the tax rate went down from 37% to 20% on that $1.5 million portion of the sale. And that's a huge savings. That's $255,000 in tax savings. Best of all, the f-reorgs, they're really not that expensive to do. I think we did one for this trucking company that was, it cost us $5,000. So it cost $5,000 to save $255,000 in taxes. Now, as always, anything related to taxes, it can be highly complex. f-reorg is a highly complex tax transaction. You really need to make sure you talk to your tax advisors. And if it's something that your tax advisors are not familiar with, reach out and we can connect you with some who are. But this is why good advisors are so important during a business sale. Small mistakes or just not knowing about these little simple tricks can cost you a lot of money. And good advisors will pay for themselves over and over and over. So if you have any questions about getting ready for a business sale, drop them in the comments. And if you're ready to list your business for sale or want to start prepping your business for sale, send us a message.